My name is Nic Chahine. Thanks, Dan, first of all, for the intro and the opportunity, and thanks, everyone, for joining us here today. I'll try to do not so much of a talking head and try to relate it to real stuff that happens. And you'll see why in a little bit when I tell you a little bit more about myself. I won't make it long, but as far as questions are concerned, whenever I do a class or a seminar or a webinar, whatever you want to call them, I want to address all the questions if time allows. If not, we'll follow up with the important questions afterwards, but hopefully we'll get to all of them. I may answer some questions on the fly if I see them come by pretty quickly and they're pertinent to address. If not, we'll address most of the questions towards the end. So please ask them, and I'll try to get to all of them at the end. Today's format is going to be very simple and blocked into segments that you can follow, but I have one goal, and it's very easy. But first, I want to put a disclaimer up there because investing, however you do it, regardless of how careful you do it, there are always dangers. That's why it's investing. There's risk and there's reward. Without the risk, there's no reward. Options can be dangerous, not more so than regular other forms of investment too. So take a second here and read the disclaimer, and then I'll move on to a little bit more about myself so you can relate a little bit. The main thing is, other than the pronunciation of my last name, right, Dan? I'm a self-made trader, meaning I taught myself from scratch. I started in the business world just like most of you here. I'm an engineer, electrical engineering, and then I got interested in finance. I got my MBA. So I basically came from Main Street and not Wall Street. I'm not the typical somebody who's teaching people how to invest that came from Goldman Sachs or invested with JP Morgan or whatever. I came from a regular job, a regular background, and I just got interested into finance and somehow found my way into doing something that I enjoy, and luckily I can afford myself to quit everything else and just do it full time. You can find me on social media. I contribute all day, and you can also reach me out through regular email. And the good thing about how I do things is I answer all questions regardless of how quote-unquote stupid it may sound. So this is me. I'm a regular Joe who came from a regular job who now is happy enough to trade full-time, and I've been doing it for a decade or so. So then you ask yourself, why should you listen to me? The proof is in the profits, as so they say, right? My goal is not to seek home runs at every at-bat. I'm always going for the base hits, and that's how you win a game, in my opinion. And I have over 38% returns on record, publicly posted, and my winning percentage on trades is over 90%. So over 90% of my trades are winning trades, and the ones that are losing, and they're not massive disasters. So every time I say this, over 90% winning percentage, sounds a little, cocky, not to use it, but anyway. But they say, well, what about the 10%? They blow you out. Not necessarily. If you follow your own rules and system, then you shouldn't. You should see trouble coming. Every once in a while, you get a headline that blows you out. That's unavoidable. But it's rare, few and far between. So this is not to brag. This is just to give you an incentive why you should listen to me. I'm looking to make a living with low risk and have consistent income, period. I'm not looking to buy something for $10 and sell it for $1,000. That'll be great. I'll take it if it comes. So having said that, the agenda today is very simple. I'm going to talk about option spreads and obviously a little bit about options. I'm going to assume that most of you have heard of them, dabbled in them. These are not the stock options you get for taking a job. These are contracts that are almost every ticker, let's say Apple, Google, S&P, all of these indices and regular stocks have option contracts. They're called option chains, and they expire, most of them, every week, all the rest monthly. So you basically take a contract and it expires, and you win or lose based on your guess of where you put the contract. So you have a pretty good control. I'm also going to talk about my specialty, which is credit spreads within this world of option spreads. And then I'll tell you why it's exciting to me, and maybe it'll excite you too. And I'll tell you how to trade the ranges, and this applies for anything. For whatever however you invest, this will interest you and will help you. Managing trades also applies to everything, but then I hone it into my specialty. And then I'll tell you what I'm doing this year and how it's paying me. So this is simple, and you can follow it, and I'll refer to it every so often just to keep us on track. So the agenda is simple, and the curriculum is simple as well. So let's jump into number one, which are the world of options. So why should somebody worry about options? Why options? I get this first. I do stocks. I like to buy them low, sell them high, short them high, buy them back low, regardless of how you do it. Why options? Well, the simple answer is that options, you get more bang for the buck. That's no doubt about it. And I use old examples so I don't entice anybody into thinking that this is a that this is a just that works this time. This is from when Google was 1036. So obviously that was before the split. So I still use it because I don't want to use anything from now. I will use from now just to make a point that it's timeless. So on a day where Google jumped up 2%, hefty win for a big stock, right? So if you owned Google the night before, you woke up 2%, sweet, you made a bundle. But had you done the same thing with the options, you would have been up 50% almost. So bigger bang for the buck, and without risking as much. Here you're risking, if you did one share, that's without, but how much can you make doing one share? So if you did 100 shares, how much did that cost you? 100 times 1,000. So you risked $100,000 to make the 2%. Good money, but you risked $100,000. Here you didn't. You risked a fraction. You risked, if you did one contract for 100 shares, you risked 100 times $3.45. So, and you pocketed 50% on the money risked. So bigger bang for the buck. Bigger bang for the buck, undeniable. Spreads are safer than naked options. These are spreads. If you notice here, I put spreads. Naked options work even bigger bang for the buck, but for me, I'm conservative. I want to risk less. I want to hedge my bet, and having a spread hedges your bet because you're buying one, selling one. You're basically buying 1025, selling this one, or selling 1025 and buying this one. Regardless, you always have, if price moves against you, you have one gaining, one losing, so you hedge your bet. Safer. And I can focus on profits if it's safer. This means I pay less. Instead of risking 100 grand, I'm risking $300, or if I want to do it 10 times, $3,000 is still a lot less. So I'm risking less. And decent profit, decent, 50%. Okay, that was one day. So these are just reasons why I like options and why I like option spreads even better. This gives me conviction. So when first of all, when I trade, I have a thesis. I'm not trading blind. So whatever thesis I have better conviction because I can withstand heat a little easier, right? Which makes it easier for me to manage the position. I'm not sweating bullets, and I don't have to watch my screen every day, all day. So this is why I do options and option spreads. Options because bigger bang for the buck. This is not options, straight up stock. This is options. Why spreads? It's just safer. Less money on the line. Yeah, potentially less profit, but like I said, you can win a game just with base hits. No, 50%, Greg's asking if 50% is an average target. No, it's not. And we'll talk about targets a little bit later. Everybody draws targets somewhere different, right? So now that I've talked about option spreads, I told you earlier in the agenda that my specialty is credit spreads, which just basically means that I like to sell the option spreads rather than just buy them. That's where. Okay, before we go there, I told you I'd show you a different time frame. So this is recent time frame, somebody else. And again, on a day, you can see the minus. So if you shorted the Russell the day before, you would have made 1.53. So here, this is a long thesis. This is a short thesis. If you shorted the Russell the day before that incident, you would have made 1.5% basically because you were short. Had you shorted it using the options, you would have made 60%, 90%. It depends on what spread you took. So bigger bang for the buck, proven again. A long or short thesis. So credit spreads, that's what I do. So this is a non-distinct options chain, regardless of what this is. Credit spreads, the part of credit means I'm selling the spread. So where the color changes really is where the price was at the time of the snapshot. So let's say price is about $12.05. Okay, $1,205 per share, whatever that is. And I want to be bearish. If I'm bearish, I buy puts. These are the puts here, right? And these are spreads. So if I'm bearish this chain, I can say, you know what, in the next couple of weeks, I think price is going to go down. Therefore, I want to pay 85 cents. And as price goes down, this 85 is going to increase in price and be something like these guys, right? Hopefully before time expires. You're welcome, Greg. And if I'm right, and indeed price goes down, this goes up in price. That's the regular spread. What I do is I prefer to flip the formula around, because you read that 80%, whatever, it's a high percentage of options expire worthless, meaning if you buy them, you're a loser. Not personally, but you're a loser on that trade. So why not flip it around? And it took me a while to get to that epiphany, but hey, I can make money selling the spread instead of buying it. So I have right off the gate the statistics on my side. If I choose my level correctly, and if I'm not greedy. So I can sell this 1155 spread, and if in the next couple of weeks, if this is a 2-week left on the trading period in this contract, this price does not reach 1155, I keep the 85 cents. 85 cents sounds fiddly, but if you do 10 contracts, each contract is 100, so 10 times 100, that's 1,000, so this is 850 bucks. So if I sell it, $850 goes into my account, and if I'm right, it stays in my account, it's mine. I can close the trade at any point in time by buying it back. And if time has ticked by and this becomes 45 cents and I buy it back, the difference is mine in profit. I made 40 cents. So it sounds like small money. But you say, well, this 1155 is not that far away. Okay, well, I'll go down here and I'll take 50 cents. So let me walk you through the logic here. You get paid to enter a trade. The money goes into your account. You sell it, the money goes into your account. You define your risk. See, I told you 85. What if I'm not that gutsy? Yeah, well, you define your risk. You go down here. Right here, your risk is 50-50. So let me ask you this. When you buy a stock, when you have a thesis to go along a stock and you buy it, what do you think your chances of success are? It's 50-50. You can be right, you can be wrong. Statistically, yes, you can do homework and skew the results this or that way, but it's still a coin flip. It's a coin flip. Can you believe it? It's a coin flip. Nobody says that on CNBC. So why would you want to invest via coin flip? I want to skew it. I want to go down here and make it 90% chance of success. If I go down here, it's probably 90, close to 90. I'm just eyeballing. You can find out exactly the number, and there's, most trading platforms will tell you the chances for this to be out of the money on expiration day. So you define your risk. If you're a risky guy, you want to do 50-50, you sell this one, you collect 2,500 and sit and wait. And it's a 50-50. You could be right, you could be wrong. That's not for me. I'm conservative, so I go and I go to 90%. That's how I get to 90% actual results. Low maintenance. If you go down here, you think you have to sweat every tick every day? No. You can go walk the dog and not have to be blasted to a screen. And there goes the market. And you can not worry about the minutia. So low maintenance. Time is died. As time ticks, nothing else moves. You're making money because this is getting cheaper with time. It's called theta, the time burn. And I choose the winning odds, which is basically defining my risk. These two are the same. So the odds of winning here is 50%. Odds of winning here is 90% if I'm selling them. So it's pretty exciting stuff. And I hope I create the epiphany here today. By the time you leave here today and say, wow, there's a whole world I need to follow, I need to learn more about, I'll be more than happy to teach you, show you the ropes there. And I enjoy teaching it, and I've done it for years, and the feedback I get is my form of payment. It's incredible. It's like a high. So elements of the credit spread. Now that I've piqued your interest, elements. That's all I do, by the way. That's how I create my income, credit spreads. First, risk. Now, when you say risk, do you know what risk is? You'll be surprised. Probably not. So risk size, obviously. How much am I risking? Am I taking 1 contract, 10 contracts, 1,000 contracts? How big is my bank account? I can risk position. So first of all, risk is not just, when I say risk, most people say yes, and then when I drill them more, so tell me, what is it? They hesitate a little bit. They're not sure. So risk, first of all, is dollars. How much am I risking, right? So that's risk size. That's one element of risk. The other one is incident. What are the chances of me losing money? So risk size and risk incident. So how much am I risking, and what are the odds of losing? So that tells me where I put the risk, okay? And people glance over that often. And then the other side, risk management, really management, not just watching. Manage it. Watch it and do something about it if it moves this way or that way. And you have to do something either way. If it moves your way, you have to book profits. If it moves against you, you have to avoid the blow-ups. Zero hopium. I love this new word that should go into the dictionary. Zero hopium. Be true to yourself. I mean, there's no way. So how do you pinpoint these opportunities? Knowing that all these are risk elements. By the way, these apply to anything. If you buy regular stocks, short stocks, bonds, whatever you're doing, you have to know what you're risking, what are your chances of losing, how to manage your risk, and really be true to yourself. So write these down and apply them regardless of whether you want to try the credit spreads or not. So this is elements of credit spreads or anything else really. So for the credit spreads, it's as easy as 1, 2, 3. How do I pinpoint the opportunities? First, I have to find the levels. So homework is required. You can't just throw darts and hope for the best. You have to do homework, and homework is available out there. A lot of people offer it as services. So if you don't have time, ask. So, but don't throw darts. Know the subject. Don't jump into something you see on a commercial, and know the influencers. What moves your subjects? Okay, politically, anything, sister companies, so you don't just throw darts. And then once you know the levels, you sell spreads outside of those levels at the comfort level that you want. You collect the premium, cha-ching, and then if successful, you keep the premium, you generate income. But meanwhile, you don't just sit back and watch it. You actually have to manage it, right? So the management part, that's 1, 2, 3. Find it, set it, and don't forget it, like Ron Popeil used to say. If it expires worthless, that means the trade is 100% successful, and they call it maximum gain. Profit is when you buy it back for less than when you collect it, and you can do that at any point in time. I do that all the time. People don't do this often enough, and that's why they have blow-ups. They're afraid of leaving money on the table. Guess what? It's part of doing business. Successful traders all leave money on the table. And successful traders all take losses whenever they think they need to. Don't be scared. So these are as easy as 1, 2, 3. It sounds too easy, but it really is this easy. So trading the ranges. In the agenda I told you we're going to talk about options, and then we're going to talk about how we're going to trade the range. Well, first you have to find the range, right? You can't just jump. Well, what is the range? Well, I don't know. And then find the trades within that range. Sounds like mumbo jumbo, but it's really simple, and I'll shed some light on this one. Trading the ranges, first define it. How do you define it? Basically have a plan. You start with a macro. What does the world look like today? What happened yesterday? What's in the geopolitical? What are the risks? What's Europe doing? And then you develop a thesis. My thesis is that it's been all year, and now I'm testing it again, that we have room to meander and move up, but I'm not afraid of a plus 10% move on my shorts if I have shorts. So I do see safety nets. The Feds all over the world, they're still here, right? And I also do, I constantly check for pitfalls, because you never know. I'm the guy driving on a nice smooth freeway looking for potholes. I told you I'm conservative. So I watch for pitfalls. But I develop a macro thesis, and I constantly test it. And I look for warning signs, and I have warning signs all over the place. That's why I'm more comfortable shorting than going long these days. And I think globally, all over the place. I mean, I cover the globe with my news. I read everything. And without it, I think I'm lost. And then test and test and test and test and retest. I told you that already. Like, for example, today I added to my list of worries politicians. I'm pretty sure every year around the holiday they start messing things up. So this is my macro. I have a macro look at the world. From that, I look into micro thesis. Okay, so knowing the world looks like this, how can I trade Apple? Or whatever interests me. How can I trade VMware? How can I trade Google? How can I trade the indices? How can I trade bonds? So I maintain a watch list. Without a watch list, don't trade. You have to know, you have to track, you have to get the beat on the tickers you trade, and it could be indices, stocks, whatever. So within the macro, find the micro. How can I trade this? How can I trade that? So if the watch list, I have to maintain it, meaning I run through it every day, at least once. I use a penalty box. Some stuff looks funky in the watch list, like Apple last couple of weeks on the crazy run-up. I was like, I don't understand this run-up. I'm not trading it. I put it in the penalty box. I have no issues. Cash is a trade. If there's no inflation, as they tell us, at least it's not measurable, then I'm not losing anything with cash. Then it's definitely a trade. And nobody's paying me much via interest, so I'm not missing out on anything. So cash is definitely a trade. And I avoid catalysts. Anything I'm trading, I avoid. If Apple is reporting earnings, I don't trade Apple via credit spreads or any full-size position. Why? You can hand me the P&L ahead of time saying, here are the results from Apple. You can take a peek at it and then put your position. I don't know how the market's going to react to it. One time they counted the words that Sergey said when he first came back as CEO of Google, and he had issues with his larynx. And they said, oh my God, you only said 137 words or whatever it is, and they sold Google 100 points. So I don't care what the numbers are. It's still a coin flip on how the market's going to react. So I stay it out. If I want to play it, small fun positions via the options, just to participate, lotto style. And I sit back and I put the trade right after with the intelligence in hand. So that's how I trade the ranges. Okay, so what can I do with credit spreads? All right, so the credit spread world allows me to do a lot of things, and I'll tell you what happened to me this week. So you can do credit, everything's credit, this, credit, that, put spreads. And these are bullish positions. I know it says put, you usually hear it as bearish, but I'm selling them, so I want price to stay away from them. So if something is going like this, I sell a put spread here, and I want price to stay above it. That's how I collect my premium. Credit call spread, if I see something going like this and I say that should revert and go down, I sell risk here, credit call spread, and I collect premium. And if price doesn't get there by the time it expires, I keep my premium. Or I can do both. I can do, hey, you know what, this is range bound, so I can sell risk here, I can sell risk here, collect twice as much premium, and if price indeed doesn't reach this or that by the time of expiration, I keep both, and I bank both. And that's basically a self-hedged trade, right? So this week, we were violent, correct? We had a lot of movements, plus or minus 150 points. My portfolio barely moved, and I had a lot of trades, big trades on. It barely moved. Does that mean I made no money? Absolutely not. I booked profits every day. As a matter of fact, I covered all of my expenses and then some this week in just a handful of trades with no movements in my portfolio. Why? Because time ticked and my trades won, cha-ching, and I booked them for profits. So it is feasible. I was long the small caps. I was short the Nasdaq. They hedged each other. So when the small caps took a beating, my shorts of the when the small caps took a beating, the Nasdaq shorts, my credit call spreads went to zero. I bought them back to close them at 5 cents. And then I was far enough that my long small caps expired worthless yesterday. They were quarterlies, and I didn't have to worry about it. So base hit paid, the hedge paid, everybody happy. So even, like Dan said in the morning, weatherproof, right? He used the term weatherproof, meaning what happens to you when the weather gets bad. you know, 150 points every day movements, and I had no movement in my portfolio, and I still booked profit. That's pretty weatherproof. As long as you follow your rules to set up proper bullish trades, for example, credit put spread I mentioned, you know, put, but it's a credit, so it's bullish. I usually set up 90 to 95 chance of success, and you can find that built into your trading platform. And if you insist on that, then you only have a theoretical chance of failure of 5%. So I love those odds. I don't care if it only pays me, you know, 20 cents or 25 cents, but the return on risk is like 7 or 8% in a few days. So if you can do that a couple times a month, you got, you know, double-digit returns on risk. Who can claim that? At safety distance. So it's not like I'm playing at the money. I have safety. I add hedges whenever appropriate. I just mentioned a hedge. I traded the RUT. I sold the credit put spread, and I hedged it by shorting the NASDAQ. Why did I short the NASDAQ? Because I think Apple is heavy. 13% of the NASDAQ. I chose the NASDAQ. Okay, so you avoid foreseen catalyst. There was no catalyst that I could see besides these are indices. So the catalyst is, unless it's a Fed-related event, it's diffused. So if one company jumps, it's diffused across the index. And I always test it. I don't just take it for granted. This is small caps, whether RUT or IWM, it doesn't really matter. So if you sold credit put spread here, credit put spread here, credit put spread here, credit put spread here, you made money throughout the time. You can also have shorted it here, 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 here. So, but this is, we're looking at bullish trades. So the bullish trade would be credit put spread here all day long. Just stay away from trouble. Bearish trades, the exact opposite. It's called a credit call spread. 95%, I insist on the same success ratios. I hedge only when appropriate, and I'm gutsy. This year, last year, different story. Flip everything I'm saying around. I was bullish, 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 bullish trades. Very few bearish trades. This year, the exact opposite. I avoid foreseen catalyst tests and retests. So this is, looks like Netflix to me. By the way, Netflix has plus or minus $100 in it. No doubt about it. If it breaks this level here, which is, I believe, 495-ish, expect this. If it breaks these levels here, I can't remember, 450 something, 440. It dropped to 438, 439 a few days ago. Today is 445-ish. There's another. It's not a recommendation, but this is my lotto ticket. I'm looking to buy a lotto ticket here. So, but here is, if it's a bearish trade, if I think that this is going to continue to be a roof, I find a level I'm comfortable with, which I'm not with Netflix, but credit call spreads there. Okay, so this is what I would do with that. And here's another one where you could also do the same thing with, I just laid it out for visual reference. Stagnant trades, you can do both, and I've already mentioned that. The theoretical percentage shows as this, which I don't agree with. It's really 95. It's you say, but you're doubling your risk, right? Because if the stock is doing this, then you, in theory, you think instinctively you say, wait a minute, you're doubling your risk. No, I'm not. If I do a credit put spread here, right, and I'm risking, let's say, $4 wide trades or $5, then I do another one up here. You say you're risking, now your risk is doubled. No, it's not. I can only lose either here or there. If price goes up, this loses its gains. If price goes down, this loses its gains. So I'm not doubling my risk. I'm doubling my risk incident, but not dollars. Remember, I told you risk is 2. Chances of losing now is on the upside and the downside, but I'm not increasing the dollars of risk. So it's a good thing to do. And if this is 95% chance of success and this is 95 chance of success, why isn't the total 95 chance of success? It is self-hedged, so you don't need to hedge, blah, blah, blah. So blah, 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 because I just want to make sure I cover everything. So let's apply the method. There is a question, what would be the percent of your portfolio in weekly options versus normal maturities? Bart is asking, how much do I use weeklies? I really don't care, Bart. Weeklies are option contracts that expire every week, every Friday. Most tickers have them, especially the big ones. So people are enamored by using them. Well, I use them, Bart, but why use them for this week? Like, I'm done using this week's options. I'm already into next week's options, and I book them early. Because if I do this trade this week and I get a headline, and let's say I'm doing Netflix, and Netflix drops $20 because it got rejected it's got boycotted by AMC Theaters, which by the way is a real headline and is down 1% today, and I get blown out, I have no recourse. My plan B just gone out the window. So I like to play the weeklies, but I really don't care when it expires as long as it's not this week. I don't want to be in this week's weeklies already still, and it's Wednesday or Thursday. I'm out and into next week. I rarely try to go to full term with it. I hope that answers you, and I think it does. Okay, so let's apply some method. This is the old Google before the split. I really don't care when or what or anything. I just like to make a point. So if I see a pattern like this, sorry about the lines, but I wanted to show you. See this line, whoopsies, right there? Okay, and I see a well-defined pattern. Okay, I can trade this. Let's see how. Okay, I can do what? I see a trend. I want to trade it. Credit call spread. So, okay, I'm gutsy enough to do this. Whenever it's not reporting, see, I avoid these guys. I avoid these guys. So I don't do one here because I know there's earnings. And look what happened here. Had I done it, boom. So avoid the earnings, avoid the catalysts. Credit put spread, I'm gutsy also doing this, and also I'm gutsy doing both in this type of environment. Okay. And as far as doing both is a preference, and sometimes if you have conviction that it's more bearish than bullish, then you shouldn't do these. Here's one incident of that. If I was going to go, I saw a trend, Google was holding this line, and when it got down to here, I was like, wait a minute, I need to go. That's why I use this. This is so old, but it was a perfect example. So, and then I said, okay, I'm looking to do a credit put spread somewhere around here. And then I said, wait a minute, I see a head and shoulder pattern, a well-defined one, and that could have ominous results. So I waited it out just one day, and then boom, big red candle. And sure enough, the head and shoulders came to fruition. Now, I'm not a technical analyst. I'm pretty proficient at technical analysis. I don't use it to troll trades. In other words, I don't troll charts to find trades based on technical analysis. I use technical analysis as a last step, like a consultant, after finding my trades to see time of deployment. Am I going to deploy it now, or should I wait? That's how I use technical analysis. So this is an example that I keep referring to. I dug it out just to visualize it. And then we have the extreme price line. I mean, price line is a fast mover as any stock ever. It's a momentum stock, so-called momos. They reported recently, back in February, and they had violent reactions. They showed me a low and a high. The reason I'm doing this is that these trades are based on longer terms, and you can do this intraday. And I did this at that day. The day opened, and I think it was a Friday. And before the open, they reported, after the open, they reported, and then boom, boom, that was pre-market hours. You can't trade options here. And then at the open, I said, you know what, I'm going to take a shot. They showed me worst case scenario. They showed me best case scenario. So I sold credit call spread here and credit put spread there just for the day. And I collected hundreds of dollars, 15 cents here, 15 cents there. And I was watching it like a hawk, and then sure enough, the open, big candle, a lot of volume, and then fizzled right in the middle, and these expired for maximum gain. So you can do this at any speed you want, any speed you want. These are trades that you can do any point in time. This is the NASDAQ, and these are real trades that I did, and they're all profitable. And you could do them at any point in time. At this point in time, 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 any point in time. This year, I'm more bearish than bullish, meaning I'm easier selling credit call spread than credit put spread. Okay. So yes, you can do these trades, great, but you got to manage them. So remember the bullet points from the agenda. Managing the trades is a really important, and I mean managing. Not just watching, just really manage it. Somebody's asking what's a realistic amount I can make from each week from this method of trading. That all depends on the size of the account, the activity level, and the level of aggressiveness. I'm conservative. I have a different size account. I cannot give you an answer because it all depends on all these variables. Somebody looking to just supplement their income, then they can do that, with one trade every couple of weeks and make, just a few bucks here and there. So $200, $300, $400 a week, $200, $300, $400 a month. It all depends on the level of activity. If you do a couple trades a month, then it's easy to give yourself. I call it giving yourself a raise. I don't know if you caught it. One of the headlines shows giving yourself a raise. So that's what I do. It all depends on what the accounts are. You can't. There's no one size fits all. That's basically the bottom line. So this is a hard question. I get it often, but I can't. There's no one particular answer. So managing risk is really important because you can't just set it and forget it. And what are the elements there? First, we define what's risk. Okay. So you got to manage both sides of it. Separate them. Once you set the dollar amount, okay, now you're comfortable. I know I risk this much. That's the side. Now I manage the percentage of loss. If my percentage of success starts to be a coin flip, this trade is broken. I need to adjust it or close it. So that's how you manage risk. And then I scalp. So if I open a trade, and especially in the momentum stocks, and I get a jump, and I'm suddenly can book half the maximum gains in a few days, and there's so much time left on the trade, I close it. I scalp it. It's like scalping with other people's money. Sometimes I open a trade knowing I only want 30 cents out of it, and I'll close the rest. So if it hits the 30 cents level, I close it. It's a preset target. I close the credit spreads before the expiry. I don't usually let them expire worthless. Yesterday was an exception. I couldn't close it. I tried. I couldn't. Zero hopium. Zero hopium, zero hopium, zero hopium. Any form of trading, please. Don't. If you say, I hope it turns around tomorrow, if your only thesis is that tomorrow we should bounce just because, then you need to cry uncle, meaning you need to give up or change it or do something. Oh, Ziggy asks, when do you close a trade if it goes against you? That is such a complicated answer that I can just throw 2 hours just based on that. I have preset levels where I say, okay, if it's 60% or 70%, depends on the ticker, but most of the times if it's within one standard deviation, so if my chances of success is 70% or less, I like to get out. It's pretty close to a coin flip. Coin flip to me is zero, unacceptable. That's just full hopium. That's Vegas. That's Vegas. Hopium. Flip a coin. That's not investing. That's not for me. Okay. So great question, Ziggy. We can have a sideline conversation for hours about that. I love it. Okay, smart people in this room. I love it. Thanks, Dan. Managing trades also involves you got to practice taking profits. Sounds silly, but if I have a spread here and it's gone down and the time is expiring, or if I open the spread at this point in time, a credit put spread, and then this price rises up to here, so I have all of this in profits, chances are this is so cheap to buy back. Take profits, practice. It gets easier, and it gets more, now it turns from paper profits into real profits, because if you wait and then suddenly you get something goes against you, you never know. So book profits. Now it's money in the bank. Okay, this is the beloved Apple when it fell from grace of 700 a couple of years back. Everybody hated it, hated it, hated it. Everybody hated it even here. Are you kidding me? Okay, so how did you trade Apple when it hit 410, which is what about here? I wanted to go long it. I knew it was undervalued, but I didn't want to fight stupid. So how did you do it? Did you go long it with a stop loss? Most people buy the stock and then they put a stop loss right, a couple of dollars lower. So this is what really happened. This was the point in time where we showed you here. This is the point in time right there. Okay, so I wanted to catch the knife. So don't throw darts. Only just take it. So you pick a level and then you pick a buffer and you manage it. So I picked a level. And I entered somewhere in the middle of here. It was like 390 or something. And I said, and then I saw somebody posted that it's going to 260 or whatever. I was like, you guys are nuts. The math doesn't work out. With the cash, it cannot go down that low. So it physically cannot. So I took a trade with a big buffer. I believe it was 350. So I sold a huge position in credit plus spread at 350. So I left myself a buffer. So even though it went down a little further, I didn't have to do anything. A stop loss would have blown you out of the trade at a loss, and then you would have regretted it because it then recovered. It's old history. So I did it here, and then I managed it, and it won. So did I hedge it? I didn't need to, but I always consider hedging trades. Always consider hedging trades, because that's the only way I can assure myself some money coming in if I guessed wrong or my timing was off by a couple of days. I don't hedge every trade, because I just don't feel the need, especially if it's a credit call spread these days. I do consider the overall portfolio delta. I mean, this is so different thinking, because if I take a new trade and if I decide to hedge it, like if I go along the small caps today on a down day, I don't hedge it if that's the only long I have and the rest are shorts. It in essence is a hedge to my entire portfolio. So consider the whole picture before you short. Like if I was long the small caps and I wanted to take another long position, I'd think twice about it. And if I do, I take it lower because I know that I'm already heavy long, or I take another, but I add another short position by a credit cost spread. Bert's asking on average, how expensive are the options I take? I'm not sure I know. I deal with high dollar stocks just because they offer high premiums and high dollar tickers, I should say. And it's easier to go safer with more money. So that's probably as best as I can answer it for you. And right now, as we speak, I can probably book a profit on a trade I did yesterday, but I don't want to leave here. I shorted the NASDAQ yesterday, and I collected about 90 cents, and I can see it's about 60 cents to buy back. I shorted it yesterday. I sold November, that's 2 months out, 43.30, 43.40 credit call spread. So, and I collected 90 cents for it. I don't leg into the position. I do the spread at one time. And I collected 90 cents, I think, between 85 and 95, I can't remember, and today it's 60 cents to buy back. So I can go ahead and buy it back and close that trade, and if I did 10 contracts, that's $300. If I did 20 contracts, that's double that. So, and it's just a few hours. No, I don't. Gary's asking if I leg out of a position. So if I do have a credit spread, do I close one leg and then the other? I find it more risky than rewarding, and the only reason I would do it is if I cannot sell the long leg that's a protection, so I end up buying the short leg only and leave the long leg as a lotto ticket. That's the only reason I would do it. But I don't try to game that part. I call it a win, I call it a loss, and move on. So that's how you can scalp. So maybe that 60 cents will still be available when we get out of here. But I also shorted the NASDAQ earlier that ends this week, and I closed it for 5 cents, and I had collected 45 cents for it, and in just a couple of days. So dollar amounts, previous NASDAQ take. Yeah, Bert is asking a little more detail on that. Well, I guess we'll throw the curriculum and all just for the time. Okay, so the NASDAQ was at 40.45 or 40.50, so 4,050. I said, you know what, between now and November, it's not going to be at 43.30. So that's like a 6% move up buffer. So I said, okay, the NASDAQ is trading right here right now. Let's say it came from, and it's right here at 40.50, okay, 40.50. And I said, okay, by November, this is October, this is November, by November, I'm going to sell a credit call spread right here at 43.30. So I'm taking a risk. Sorry about the handwriting. This is left-handed mouse. 43.30, and then bought the 43.40 to limit the risk, right? And I collected 90 cents. So, and if I did it 10 times, so I collected $900, went into my account. And as long as the NASDAQ doesn't jump up 6% between now and November, that $900 is mine. Today, I could buy it for $600. I could buy it back if I did 10 contracts. So I made $300 in hours. I did it last night just before the close. I can close it right now for $300. Or I can leave it on. I'm fairly confident. And as a matter of fact, if the NASDAQ drops today, I can do a credit put spread and collect another 90 cents by taking a $3,700 level bet and saying, okay, it's not going to get to 43.50 or 30, but it's also not going to get to 3,700. and double end it and take, let's say, 70, 80, 90 cents, whatever it is here. I don't have it in front of me. So now I collected $1.80. So now my return on this trade, if it's successful, is like almost 30% on dollars at risk, period. How do you hedge credit spreads trades? It's a complicated answer, Dan. The hedge can be many ways. You can do iron condor, then it's self-hedged. This is called an iron condor when you do both flags. That's one way to hedge it. Another way to hedge it is if you can do another ticker. So if I'm short the NASDAQ, I can go long the S&P. And then if the markets are running up, then the S&P and the NASDAQ are running up, then this one gains, this one loses. That's one way. Sometimes if I took a November trade there, I do an October trade that's a debit call spread. So I buy a bullish position here for the NASDAQ. So if indeed the NASDAQ goes up, this accumulates dollars faster than this loses dollars because it's closer in time and lower in value. So I'd be basically doing a long trade for free because this one will gain and then I'll sell it, and if it never reaches this one basically gave me this trade for free. 10 contracts on the NASDAQ for 90 cents is how much in a dollar? It's $900 minus fees. So right away, do you strangle the volatility that's high? I try to strangle whenever I can. I rarely do naked strangle. I did one in Google this year, and it's massive, and it's a massive win, knock on wood, hopefully. If I book it now, it'll be a giant tax bill for me, so I'm holding out as long as I can. So, okay, we're off topic here. I use that as an example. Come on, people, let's get back in line. You can start credit spreads with a small account. You can do it with 5. It's very limiting. You can do it with 10. 25 is really comfortable. You can consider $500 a month and 25, no problem. At least I can. Okay. You can use options. If you have a full position in Apple, you can use or Google or whatever. You can use options to hedge full-size stocks. So if you own a stock and you're afraid it's going to go down, you buy a put or put spread. That gives you protection. If the stock goes down, your put gains money, but more importantly, it gives you the right to sell your stock at this price, regardless if it's zero or not. So hedging, that's managing trades. Then you have to manage risk, really. Remember I told you dollar size and risk of incident. So the dollar side is set aside because we know what the risk is going in, and we're not changing that. So managing the risk means that you have to close the risk at preset targets, meaning early at scalps. That's managing risk. Take away, saying that differently, I say it every day. Close cheap risk. That's how you say this. Don't leave cheap risk open. Yeah, there's no need for that. Close at preset targets. You have to, if you have a target and it hit your target, I already said that, but it's pretty important. You have to close it. So you close cheap risk and you close at preset targets. And then you have to practice before the expiration. Sometimes people are hesitant to book the profit and leave money on the table. You have to get that out of your head. No hopium. When they cry uncle, we beat that to death. I'll show you why you close cheap risk. Real life trade from January. I keep this in the bucket because it's a perfect example. I had a credit put spread in Google. So Google was there. I did a credit put spread. It was expiring that day. That's a Friday. And it was a winning trade. It was like cha-ching, I booked 40 cents or whatever it was. And it cost about 5 cents to close in the morning. I was like, there are only a few hours. I'm going to hold out. And then Google started falling. I was like, you know what? I'm scared. So I threw out the order to close it at 14 cents. I was willing to pay 14 cents to buy this trade back and close cheap risk. They gave it to me at 7 cents. Thank you. That was a gift. So they gave it to me half price. I don't know why, but the market makers gave it to me at 7 cents. Just an hour later, this is how much it was to close because Google had fallen far enough to make this trade incredibly expensive to close. I would have lost $1,600 had I not closed in cheap risk. That's why I don't like to trade to the last minute. Anything can happen. This is unusual. It hasn't happened since, and it doesn't happen often, but it visualizes why you close cheap risk. One of these a year would pay for all these piddly 5 centers that you buy back. Okay, so the managing the risk is absolutely essential. We are running out of time, so I'm going to tell you what the go-to methods are for 2014 for me. 2013 was like this. It was a, monkeys could make money going long, all year long, all year long, all year long. 2014, completely different story. Still going like this, but the bears are not scared, and the bears are actually lazy. They're winning. They're keeping the lid far, just enough to keep the bulls in check. The bulls yet still want to run, but they're looking a little tired. So I'm doing credit call spreads with strong bearish conviction. So every pop that is identifiable as a relief pop, I'm shorting. What? Yes. So I'll tell you what a relief pop is. The relief pop is when everybody's worried about Yellen raising rates tomorrow or whenever she speaks. That was like a few weeks ago. And she doesn't, and we rally. That's an identifiable relief pop that something bad did not happen. She didn't change the fundamentals. She didn't say, I'm bringing in more QE. Fundamentals did not change. We're popping on relief. I shorted. And it always paid this year. It every time, every bounce that's over, that's been on the backs of momentum stocks, like if you see the S&P flat, NASDAQ is up 30%, 0.3% just on the backs of Netflix, LinkedIn, Tesla, Twitter, GoPro. That's a pop I would short because those guys have not had 2 days green in the back-to-back or a strong day, more than 24 hours in a while. So I would, in general, not, you may find one guy that did it, but in general. So credit call spreads are winners for me. I do iron condors whenever I feel like I'm too heavy on the short side just to mitigate the risk. So I do the credit call spread. I do another one underneath it as a credit put spread. And the credit put spread is only on strong bullish conviction. And this has been rare. I've done it a couple times this week, and I'm already regretting it. But no losses yet. Just trades under pressure, but they have not hit my level of warning yet. So I'm managing them by keeping a tab on how likely they are to win or lose. So right now, let me peek at the questions. I know they're coming in fast and furious. What is the minimum amount? We already did that. Waiting on the Google profits to go down to reduce tax bill. No, I mentioned the Google profits. John is asking, no, I'm not. I'm waiting until January. It is I used leaps, January calls and puts. I did strangle on Google. That has right now plus or minus 20% buffer on it. So as long as Google doesn't move plus or minus 20%, it's a complete winner. I collected about $60 to open a trade, and now it's about $8 to close completely. So the difference of profits is profit. So if it was, just do the math. If one contract times 100 times the dollars I collected is the profit on it. So it's a big bill, and I'd rather pay it next year than this year. That's all there is to it. This is complicated but worthwhile. What do we start to learn? Basics. I'm glad you asked, my friend. I'll let you know in a second. But right now, do you have any other questions that I may have missed and I didn't answer? I tried to scan the question log, but they come fast, and I just want to make sure I didn't blow past ones that are important. So re-ask the question if you feel that your question has not been answered or addressed. Credit spreads are not, magic. All trading is based on fundamentals. I am a fundamental trader. I do not hunt trades based on technicals. I have good friends that are so good at it. I'm not that way. That does not suit my personality. My personality is I am a conservative guy. I'm a planner by nature, for crying out loud. I was in finance for a while, and I was an engineer before, so I like the world to be linear, and this is not. But I try to make it as linear as possible. Thanks for the question. It was awesome. Yes, I do. Yes, I do. 3,000 is limiting, but you can learn how to do it and build it up $1 at a time. For a $3,000 account, if I had a $3,000 account, I don't advise on values or amounts or anything like that, but if I had a $3,000 account, I could, and it's not my nest egg, really important for it not to be my nest egg, I would use maybe the SPY and the IWM because they trade in 50 cents and $1 increments, and then I can do credit spreads in smaller dollars and just build up the account that way and get the practice. Yes, I do have a subscription service, and we'll talk about that in a little bit. So I'm a fundamental trader. I follow fundamentals. I track companies. I do an analysis on them. I read up on them, and I develop my own thesis. Like they say, don't trade Apple with emotions. I disagree. I trade it only with emotions. When people love it, I avoid it. When people hate it, I look at it. And when people were loving it, going up to 100 again, which was the 700 level, and I'm thinking, I need to see a flying car before I love it from here, because I think you guys are going to spin it in its face when it tells you they can't deliver the 600 million phones they're going to sell in China. So they can have all the orders they want. If their chain of supply is bad, then they can't sell them. So the news, they popped on the news kind of this week based on the fact that China phones, the phones have been released, been okay to be released in China, and they said they're going to be available in October. So I'm thinking to myself, you can't even make them available in the U.S. You can't sell 6 Pluses here because they're not available. What makes you think you're going to satisfy a market with 1 billion people? Potential users, I should say. So iffy on that proposition with the Apple. So when people love it, I kind of avoid it. I don't try to short it because they may deliver a flying car, highly unlikely, proverbially speaking. But if they do, I want to be ali, as they say, away from trouble. So again, weather reference there. Dan mentioned it earlier. Weatherproof credit spreads offer me a, here's the thing. People say, how do you know you're too risky? If I wake up and somebody tells me this is the worst case scenario, it has happened, if I'm nauseous at the money I'm lost, then I'm too heavy one way or another. So be comfortable with the level of risk. So that's the first part of risk. Manage risk. Dollars. How much do I have on the line, and what's the likelihood of me losing it, period. So if I set a trade that has a maximum potential loss of 5,000 and I'm going to collect 1,000, that's a pretty good risk reward for me. Some people see the opposite. Oh my God, you're risking 5,000 just to make 1,000. Yeah, but if you flip it around, look at the percentage. Divide 1 by 4, because that's really the dollars at risk. I'm collecting 1, but I'm risking 5, so I'm really risking 4. So you divide 1 by 4. You know, it's 25% return for 2-3 weeks worth of work. That's pretty kick-ass. So it depends on the perception, how you see it. How do you see it? So having said that, and having somebody that asked about, you know, I wish I had more time to teach you everything there is to be taught about credit spreads here, but there isn't, obviously. So having said that, yes, I do have. And I have an offer especially for set up for MarketFest here. This is me again. I have a Create Income Weekly, a newsletter basically. It's relatively new, but not the service itself. The format that we have here is relatively new. The service has been established for a few years, and it's doing really, really well. I provide detailed weekly analysis and via video and follow-up videos as well with actionable ideas, meaning I go through all the major tickers and indices, and I tell you what the ranges are going to be for the week. Every week I say, okay, based on the open interest in the market, based on what I see in the options markets, I think, you know, the SPX is going to be between here and here. The SPY is going to be between here and here. The triple Qs are going to be here. Apple's going to be here. Google's going to be here. I give you all the ranges, and if anything major happens in between, I update you. If any extraordinary events happen, I update you. Detailed and charts, trade ideas, simple explanations. You can also, I have the Mastering Credit Spreads series of education. It basically goes through what I did today, only on steroids. It's all by itself, it's $100. It sells on MarketFi right now. But really, this alone is worth the money. I mean, this price right here is, if you're serious about learning, if you're intrigued at all with what I said today, and even if you think it's all hogwash, I made it as cheap as possible for you to jump in and either laugh in my face and say, oh my gosh, how could I have been so stupid to even think about not doing it? But I answer all questions almost immediately. The only reason I wouldn't answer it is if I'm doing a webinar, or if I'm at the gym or something, or if I don't have any internet access, driving, etc. So all questions get addressed, even when I have hundreds of students, and I don't drop any questions, not one, unless technically it doesn't get to me somehow. So it's you'll have the course. You can refer to the course for as long as you want, and the course is a set of videos, each broken down modularly, so you can address this aspect, this aspect, this aspect, and then there's a recap for it that walks you through it. Where's the link? I don't have all day. I like that. Let me see. Can I drop the link, Dan? If you're there, do you have the link? Can you drop it, or let me see. I'm not a guru at this, so let me see here. I think I can do this. And entire audience and send. Anthony, since you don't have all day, can you be the first to click the link and tell me it works? I don't know, John. I recently had a perfect, Serge. Awesome. So the link works. Go ahead, click on that link and give it a shot. Thank you, Anthony. John is asking if I could recommend a trading platform in England, in the UK, to be proper. I can't, but what I can do, if you want to reach out to me and remind me of the question, well, I can reach out to all the members. I'm very certain we have some people in the UK. I had somebody ask me about Canada recently, and links works. Perfect. Thanks. I love the asker. Okay, so the question came for Canadian purposes, and I reached out to the community, and inevitably I had dozens of Canadians, and they said they recommended whatever platforms. I don't remember off the top of my head. I think it was I don't want to say because I really don't remember, but I can look it up. So if you have questions like that, I don't know the answers on the fly, but I'd be more than glad to hunt it down. So in investing, go ahead, click on the link and see if you like it. If you're serious about learning, I mean, I'm not a salesperson. I'm trying to sell myself humbly, but if I'm a learning guy, when I see something that piques my interest, I hunt it down and I learn. And inevitably, it opens up another question, which leads to me hunting that question, which leads to me to learn something new. I'm on Twitter. I follow people, very few people. I have a lot of followers, but I follow very few people. But when I find somebody that says something good every once in a while, I follow them, and then I look at their words and I see if there's anything I don't recognize. I hunt it down, and inevitably I learn. That's how I learn technical analysis. I have a lot of friends that are technical analysts, and every once in a while they post something like, whoa, what does that mean? I go hunt it down, and before you know it, it's on my radar. And I was starting to say, like, oh my gosh, I see an inverted scallop. I'm like, whoa, where did that come from? Which, by the way, made me a lot of money last year in the small caps. It's like a half an umbrella, to the right. Plainly stated. So if I see an opportunity to learn, I hunt it down. Inevitably, I have an epiphany. I'll tell you a funny story. I said it. I had a webinar yesterday for members only, which, by the way, is not listed on things here, but I do throw webinars for members only. And yesterday we had a 2-hour-long one. It was scheduled for one, but everybody wanted to stay more, so we stayed for another 2. 9:29. That was 2 days ago, Monday. So you'll get that with this price. No extra cost, by the way. It's not listed on here, but we do that. I lost my train of thought. Shoot. Anyway, what was I saying? Somebody help me. On this phone number, I don't know what phone number. You mean the MarketFi phone number? That's the office number? Oh, perfect, Luke. Thanks. Canadian brokers, I have the answer. Bernard, can you reach out to me after? Perfect, Clifford. I have the answer, but I have to refer to my notes. I don't remember. Interactive Broker, I want to say. They said that it was good, but I was telling a joke. Wasn't that funny? Yeah. Anyway, it must have been stupid. Webinars, anyway. Shoot. Must not have been important. Oh, yes, I remember. How I got to this. No, seriously, it's a serious matter. Excel. early 20s. My boss sent me, I was in marketing. My boss sent me to go ahead and go attend an Excel class on a Saturday. I was like huffing and puffing. Oh my God, Saturday. So I went to the Excel class, and I was good in Excel. I'm an engineer. You have to be good in Excel. But I wasn't a guru, right? So I'll show you why I boot up this window. It's a notepad. And then during the class, I was like, one formula intrigued me, and it was something like this. I haven't typed it in a while. VLOOKUP, let's see, A2, whatever reference it is, cell. You give it a set of reference, and you say VLOOKUP A2 in the reference set of cells, and then once you find it, give me column number 3 and false. I want an exact match. So this formula I thought was like genius. It did my job. It helped me do something during my job. I was like, what else is there? I was like, I fell in love with the formula. It turns out that you can do the same only with HLOOKUP, which is horizontal lookup. So the VLOOKUP, let the HLOOKUP, let count A, count if, and all of those, and then macros. And it's like, oh my God, there's a whole new world. And guess what? That led me into finance, which led me to here. So my point is, whenever I see an opportunity to learn something new, I hunt it, because you never know where it's going to lead you. You can only get better from it. That's my opinion. And I made it cheap enough to where if you're serious about investing, I mean, it's piddly change in the scheme of things. I mean, $40, yes, it can buy you 10 cups of coffee at Starbucks, but it's the doors it can open. Even if you don't learn much from it, but you just ask more questions that help you chase questions and answers. And if you challenge me with questions I don't know, I learn. I got a lot smarter having the service because I'm talking to hundreds of people every day and listening to hundreds of ideas and answering hundreds of questions every day. So I'm busy looking for answers. So how could you not grow from that? So I'm very thankful I have that opportunity. Okay, I think we have another 8 minutes or so, so bring it on, question-wise. I do to a certain level, but then that would be a different conversation, Bharat. And I don't leave anyone hanging, let's put it this way. So today, I've got my left eye on the stock market. I missed out on a few opportunities talking to you, but it was a pleasure. What do you do when a stock plunges suddenly? Well, hopefully, I'll tell you the opposite, Luke. Luke is asking, what do I do when a stock plunges? So I'm assuming that Luke's scenario is like, stock looks like this, I did a credit put spread, and then I woke up and the stock is here. Right, Luke? I don't know, I don't track the DAL, but I'll give you, I had a situation that was the opposite. Stock was going like this, MasterCard, and I was like, you know what, it was overextended, so I shorted it right here, and then they did the trifecta. The trifecta was, they said, we're splitting, we are increasing our dividend, and we are increasing our buyback. Like, oh my God. So I woke up to having a complete win to getting out at break even just because I had a proper buffer. Conversely, years ago, I had the opposite situation with Netflix, and Netflix stock $35 and it cost me $1,500, but that was years ago. So sometimes you can't do anything, other times you're lucky because you have big buffers. I don't have automatic stop losses because I'm watching the prices all day. I don't like automatic stop losses. Some people, it works for some people, but not for me. Dan, I covered how I hedge the spreads in relatively small detail just because there are so many ways of doing it, but this would be something that I can address through the membership, which I have several times. I have several videos in there about that, and if somebody asks me that, then I can really take some time and not, I have like 5 minutes left here, I think, if that. I don't let anything go in the money, Luke. So Luke is asking if I accept to be exercised. I don't like to do that. I have been exercise assigned before, but I had that was years ago, and it was a calculated risk, and I had the protection in place. So all I have to do is just exercise my option to protect myself. So, do I trade call and put or only credit spreads? I do only credit spreads. I do calls and put spreads as lotto tickets. Chung Ho is asking, and what I mean by that, I'll give you a perfect example. Google was trading at 880, and they were reporting the next day. I said, you know what, I'm going to take a lotto ticket. I paid 32 or 33 cents for a 980 call. The next day, Google opens at 980, so that 32 cents turns into $7. And recently, Priceline broke 1200. The day before, on a Thursday, I looked in the option chain, and I said, wait a minute, there's a 1200 put expiring tomorrow, and the next put lower is 1150. There's nothing in between. So whoever is selling that 1200 put has no protection. And I said, I bet the market makers are going to go after them. So I went ahead and paid 55 cents for that put, and a lot of the members did as well. I was a lotto ticket. If I did one contract, it cost me $55. The next day, that contract went up to $12.50. I didn't ride it all the way down to $12.50. I cashed mine at around $3.50, but I still turned 55 cents into $3.50. I thought that was a pretty good bet. Do I recommend option trades every what? I only do options. I don't buy stocks anymore. And if somebody owns stocks, they should use options to protect their stocks whenever protection is due. Every week. I use weeklies, but I don't ride it to the end of the week. The last couple of weeks, I've made exceptions just because I wasn't able to close them. They were so far out of the money, meaning they were winning trades, so nobody was buying the short leg, so I kept trying to close it, and I just didn't want to waste the money because nobody was buying it. Tick-tock, tick-tock. 2.5 more minutes left. What is the difference between your standard membership and your premium membership? I'm not sure I understand. I have, this is everybody equal. You sign up to Create Income with Create Income Weekly newsletter. All you see is all you get. And the fact that we're throwing in a lifetime membership of the Mastering Credit Spreads, that's bonus. That's all by itself $100. I trade in my IRA almost exclusively. Shirish is asking, is your strategy used for IRAs? You have to set up your account to be able to trade credit spreads, meaning you have to tell the provider that you have experience in doing credit spreads, and they'll give you access to selling. We're not selling naked, so they're good with that. They're all cash secured. So if you have 10,000, you can sell a spread with a 5 or 10,000 risk. They don't care because you have cash to cover it. When do you enter your weekly credit spreads? Like now, I've already entered next week's. Yes, it should explain everything. If not, you can always reach out to me. We'll have a private session. I have webinars all the time. Monday was a great webinar. It was an educational webinar. You're welcome, Chung. Well, the taxes in the IRA are all deferred until you actually use it. That's the idea, right? You defer your taxes to whenever it's your income is lower supposedly after retirement. That's why I trade my IRA. I trade my IRA as much as I can. I obviously do trade outside of the IRA as well, but I prefer to initiate new trades in the IRA just because you don't have to worry about the taxes for now. Thanks, Gary. I appreciate it. I try to be a little different just because I don't follow the typical profile of a professional trader.